Today, it's our monthly economic update for May. Hello again, it's Martin North from Digital Finance Analysis, well, latest post covering finance and property news. Well, this is our latest monthly update as we explore the latest economic data with Nuggets News. Unfortunately, I had a technology problem and I didn't manage to grab Nuggets video feed. So what I've got here is my side of the conversation and the slides. I think you'll find this a useful conversation as we go through some of the latest highlights and discuss some of the implications that we're seeing from the latest data. Well, I just want to say I'm going to start, I think, this month talking about Australia specifically, and then we'll broaden out and talk about some of the global factors too, because there's been a lot gone on recently with the budget and everything. But, you know, it's more heat than light, I think, is what I'd say generally across the across the markets.
Yeah. Okay. Well, let's dive into the market. As I said, you've got Australia first up, and we're hearing a little bit more chatter about rate rises even being on the table now.
Yeah. So of course the RBA held the rate last week and said nothing was off the table, so it could go higher, could go lower. Inflation's higher than what they were expecting it to be. And their recent results coming out through the Statement of Monetary Policy suggests that, well, maybe by 2026 we'll be back in target. But there wasn't a lot, really, other than Bullock said two things of interest. One is nothing's off the table, including potential rate rises, which, of course, spooked the markets for a little bit. The other ones, he said that productivity is a problem. And with productivity not really picking up, wages growth is still a problem too. So the story is not yet over as to what the RBA is going to do, and I think that those who are expecting quick cuts are probably going to be rather disappointed.
Yeah, I guess the other thing we've heard in the US and in Australia is just how politicized the central banks have become now. Like it's almost... It can't ever kind of go back to that true independence of the early days with the media.
Yeah, I mean, the next slide makes just that point. And of course, Christopher Joy in Australia has been peddling this very recently, saying, all the central banks are politicized. The IMF actually came out with a report quite recently saying they are concerned with all of the elections going on around the world this year and the pressure to cut interest rates. Central banks are, quote, under political pressure. And it's interesting that Lowe, of course, who was the governor previously in Australia, and now outside of the system, was talking about that cash rates could rise. So when you're actually out of the system, it's easier to be more honest with people, I think. And, even in the conference that Powell ran in the US following the decision there not to move rates, there was a specific question on how politically sensitized are you? And of course, he denied any political influence whatsoever. Well, of course he would, wouldn't he? But the truth is that it's very hard to see how central banks are actually as independent as would want. And so we'll see as we go through this. Of course, the recent budget here in Australia is pulling in a completely different direction from the one that the RBA is trying. So you've got Tara Brooker's burnout economy theory, one foot on the brake, one foot on the accelerator.
Yes, interesting. We'll get into that a little bit more later. But real costs up 6%.
Yeah, and it's worth just highlighting that the CPI is a manipulated number, right? And it doesn't tell you the true story. The slightly better number from the ABS is this one here, which is the story about what the real costs are. And for the typical household, including those with a mortgage, it's closer to 6%. Some even more. It's worth reflecting on that because the wage price data came out from the ABS today. And they're saying that the private sector wage growth was 4.1% over the last year. Public sector 3.8, down a little bit. So if you take the true real costs closer to 6%, people are still underwater. And I think that's worth just highlighting because a lot of people have sort of been saying, oh, inflation's coming down, so real wages are now growing. No, they're not. Not if you measure them right. But of course, the CPI is a manipulated number, so I don't believe that one.
All right, so next up, we know Aussie households are loaded with debt, particularly due to mortgages more so than any other country.
Yes, and there was a couple of observations there. The first is that the debt servicing ratio is massively higher, and that's partly because of the concentration of variable rate mortgages rather than fixed rates. And the chart on the left there just shows how significant the changes have been to the mortgage rates. And going back to that ABS data point, the impost of higher mortgage costs and indeed higher rents are the two biggies, right? Which is why the costs from an inflation perspective are so much higher. And the variability of the mortgage book means that we are very sensitive to any changes in rates. And if rates stay higher for longer, it puts more people into more pressure.
Yeah, and just on that chart, when such high percentage of your income wages are going to the mortgage and just servicing, putting that roof over your head, I was talking to some friends from overseas about how much they've noticed in Australia, the chat around the table at the pub or at the barbecue or whatever is always about property, whereas some of these other countries where they're from, it's about, well, this friend's doing this startup, or someone might be more interested in investing in stocks or something, you know, do you know what I mean? But just so much in Australia, it's just dominated about who's got the most property or how much our rents are up and how much you can get now and all that type of thing compared to these other countries they've travelled to, which was interesting.
Yeah, we have a fixation in Australia about property. I was surprised when I first came to Australia in 1995. You know, even then it was the centre of gravity, and it's just expanded to almost everything. And those who are actually on the well, I got 20 properties and I'm doing really well, you know, want to boast about it. Whereas those who actually are finding it really hard to get into the market and are under high pressure want to talk about it because of their frustration. So the conversation around the barbecue is always property related in Australia, unfortunately.
Yes. Okay. So households spending a little bit less.
Yeah, so maybe not surprising given the fact that real incomes are not growing faster than real costs. The retail turnover, in other words, how much people are spending, continues to drop. And the ABS published the per capita in volume terms. So in other words, how much is actually really being spent on an individual basis, and it's way down. If you then look at the volume terms overall, with effectively taking the migration, which is strong, into effect, so we got more people spending, it's still down. So no surprise then that the economy is weak, and the growth numbers that are coming out and are expected to be over the next year or two are lower than was expected previously, because of course the retail sector and what households do is a big proportion of the overall economy.
Yes. All right. So next up, rental vacancy rates remain stubbornly low.
Yeah, and just to mention that migration still very, very high, you know, probably 600 and something thousand over the last 12 months, including a lot of students, but a lot of also people are cashed up and are coming into the market maybe to buy or maybe to rent. So the vacancy rates are ultra low. No surprise then that because of that, the rents are rising significantly, and that's putting a huge pressure on a lot of households, as we'll see in a slide or two. The other side of that is that it's pushing a lot of people who are in the rental sector to try and go buy something. And that's putting extra pressure then on the property market overall. And, you know, the logic normally is that when interest rates rise, property prices should fall. But because of that high migration, it's supporting the markets dramatically at the moment. And that's one of the reasons why, if you go to the next slide, you can see there that property prices in most places, not universally, are still rising. This is the PropTrack data. Interestingly, they are down, in a couple of places. Down in Tassie, they're not looking too flash. Melbourne's not looking too flash. But if you look at places like Perth, Western Australia, very, very strong there. And in fact, it's interesting, just the variation. Western Australia, Queensland are pretty strong at the moment. Adelaide pretty strong, but some of the other areas beginning to ease back. Melbourne is the basket case, though all of the indications looking forward is we've got higher listings in Melbourne. And so property prices there are under pressure as more investors try to sell. It's not necessarily a good sign, though. It's just a sign of more chaos in Victoria because of the high debt there and because of a lot of the rules they've brought in, specifically with investment properties in Victoria.
Yeah. And next up, any updates on a lot of changes here in terms of stress?
Well, just to say that the latest data, and I run this every month, of course, shows that the rental stress is as high as ever, 74, 75%. So 3/4 of people in the rental sector having cash flow issues. The mortgages now, those with mortgages, more than half are actually in cash flow difficulty. So the longer this goes on, the more people are actually beginning to get tipped over into difficulty. We're seeing high levels of defaults. The latest results from the banks included higher levels of defaults than previously expected. And the latest story, of course, is that because this is going on for a lot longer, more of those fixed rate mortgages are still resetting to variable rates at much higher rates. So more people are being pulled into the pressurized sector. And that's just going to, the longer this plays out, the more that rates are higher for longer, the more people are going to be in difficulty. Banks are still trying to support people as best they can. But again, in the latest results, they were talking about a rise in those under hardship. And we also know from some of our other surveys that more people are now starting to sell and getting out because they want to get out before things get worse. So the stress story is pretty bad, and this was covered in a lot of the newspapers over the last weekends. I supplied the latest data to the news group, so they've given us quite a big splash in a number of different locations.
Yeah, just one thing I'd add to that, Martin. I've read a good article about Australia's corporate insolvencies are now at their highest level in 25 years. So you've got this great granular data on the rental market and mortgage stress for households. But don't forget, a lot of these corporates, we're seeing the corporate real estate starting in the pinch and that type of thing as well. So it's hitting at all levels.
Yeah, and it's worth highlighting a lot of the building and construction sector are also falling over. So a lot of construction firms are just not able to manage their cost base. So that there are projects that were not completed. There are building firms disappearing and falling over, and a significant pressure on the construction sector, which in turn means that the supply of new property is down, significantly down, which is putting more upward pressure on property prices along with migration. So, this vicious circle is likely to support property prices for longer, but it's putting a lot more pressure on people who are actually owning or want to own. So it's not a pretty story. And of course, the budget, which we'll come on to now, was full of tricks, right? So there was, a lot of spiel beforehand about, well, we're going to do a lot to help the property market. But if you look at it, it was a lot of re-announcements of things that they'd already said. In fact, there was a very good article by Patrick Cummins who said that really this was, a cost of living handout is a trick. So what they're doing is suppressing the inflation rate slightly with the $300 going to every household in the country. Why every household is an interesting question. But more broadly, the budget itself was a little bit of a nothing burger. But interestingly, if you look at the estimates, two observations. Firstly, they are forecasting inflation to come back into band a lot sooner than the RBA. And now maybe that's partly because of this manipulation of the CPI number. Like I said, it's a manipulated number. And if you actually give everybody $300 to put to their electricity costs, and if you also support perhaps the rental sector a little bit, that's going to push a bit of downward pressure on that CPI. But the real cost, maybe not so much. The other one is that the unemployment rate's forecast to rise. And then the final point is that while they've actually celebrated an estimated surplus this year, there are deficits year after year after year over the next few years. So this is clearly a budget that is designed predominantly for the election. And, people have said, well, maybe it will fuel inflation rather than ease inflation. That'll be interesting to see. And there was a pretty damning article during an inflation crisis with the Reserve Bank on the precipice of further rate increases. It's downright reckless from one commentator. But 2 points. They did not tackle the fundamental issue of migration properly. I mean, they mentioned students a little bit, and I'm trying to dial back students, but migration is still way too high. And secondly, they didn't really help on the gas price issue because, of course, you can give people a little money to help with their electricity bills, but that money goes back to the cartel, the very people who are actually keeping gas prices really high, those international players. And unlike in Queensland, where, in fact, they started taxing excess profits from the mining sector to support the budget there. Nothing here like that was done nationally. It should have actually. So the full story is about the budget, much of a nothing burger, other than they didn't tackle migration properly and they didn't tackle the gas price issue. Those two were two politically hot potatoes, so it's pretty much gone round and around in circles. So there you go. Yeah. To my mind, not a lot of really useful stuff there, but a lot of smoke and mirrors and noise, and it's a trick.
Yeah, really important point there for people that don't understand the concept that Martin's talking about. So if everyone gets $300, it eventually works its way back up that food chain into the pockets of these private companies, often of which don't pay much tax. So effectively, the government is just increasing the profits and the salaries of these corporates. And it's the same in COVID when we do these huge stimulus packages to help temporarily, maybe, or get by, or whatever it is, whenever we have these handouts. It all basically ends up going to Coles and Woolies, or the big corporations that own the majority of things, or the landlord that owns the 20 properties Martin mentioned before. Sure, it helps you pay your rent, but it just gives them more capital and more cash flow coming in to buy another property to then make it further out of reach for someone else. So it's almost like the government doesn't have that structural understanding of economics, or they're at least not addressing it in the right way. It's always a temporary measure.
Well, I think they're captured, you see. I think they're captured by big business. And I think they're frightened of, big construction and big gas and big mining. So that they just mess around the edge. And on that, if you go to the next slide, the housing myth, right? Build 1.2 million homes, right, is what they're saying over the next 5 years. Their announcement of 12, 13 billion was actually a re-announcement of stuff that they'd already done with the states previously. And just remember, as this article shows, that you would expect to see approvals starting to ramp up. But in fact, the building approvals for the last month were 12,850 homes in January. We need an average well above that to anything like meet the target. But we don't have the builders. And they're talking about bringing in more migrants to help build the houses for the migrants. I mean, it's completely nuts. So once again, I'm afraid that policy is broken. The government is just doing little things around the edge, but they're not really dealing with the main issues. And as a few people have said, it's like a sticking plaster over a bullet wound. They're not tackling the critical issues.
Yeah, and again, as people have pointed out, that 1.2 billion homes, the $13 billion, it's a bit over $10,000 towards a house. Most houses are closer to $1 million now.
Well, you see,
$10,000.
Yeah, they're giving most of that money to the states, right? But what are the states doing? So the states are struggling because the councils in many areas don't want to increase density. So I mean, it's unfortunately it's tackling the issue at the wrong end of the story.
Yeah. All right. Moving on. So the amount of time needed to save up for a house in different states.
Yeah, this was a Finder article, which I thought was quite interesting. It's just highlighting again, in many areas, you're going to be in your 60s if you start saving before you can afford to buy a house. I mean, it's ridiculous. And again, it shows you just how broken this all is. And whilst you might be able to provide a few extra levers to, first-time buyer grants and things, property is broken in Australia, and now many people will never own their own property. And if you go on to the next slide, just to the other side of it, believe it or not, the bankers who are actually still seeing significant loan growth are now saying, well, we should actually be allowed to lend more. So, the little buffers and things that APRA imposed are too much. We should actually be allowed to dial it back. But of course, they're talking their own book, because what they're trying to do is to actually just grow and grow and grow. So effectively, what we have is a government that's captured by big finance and big business and not actually willing to tackle the critical issues that actually are there. So they sort of spray this sort of very small amount of money that they've got around the place, probably risk lifting inflation and pulling in opposite directions to the Reserve Bank. So it'll be interesting to see what the RBA does. But I'm to almost tear my hair out saying this is ridiculous. This is not actually sensible, serious policy from government. So interesting to see what will happen over the next 12 months. And it will be an election, of course, because this was an election budget at the end of the day.
Well, I think more Aussies would be tearing their hair out too if they truly understood what's going on, rather than just sort of reading some of these headlines.
Yeah, it's funny, isn't it, how the headlines, are praising the government, etc. But if you go on below the hood and start thinking about it, as Warren McKibben said, this is just it's an illusion. It's not really good policy, and unfortunately, that's what I'm seeing at the moment.
Yeah, and I think just on that broader context, like you said, I think surveys show most people aren't happy with immigration this high, while the cost of living is crazy and they can't get anywhere to live and that type of thing. So it just shows sort of how far removed we've become from what the people want and that democracy to just sort of dictatorship, profit-driven, corporate-driven dictatorship that we now have. Yeah.
Yeah, and consumer sentiment is through the floor, and it's been there for a long time. No surprise, because people, I think, are smarter than governments think they are.
Yes. All right. Moving on to the US.
Yeah,
So Powell's been talking. Oh, you go, Martin.
Yeah, just briefly talking about, so we had a bit of a wobble in the markets. We'll come on to that in a second, because suddenly the inflation bumped higher than people expected, having been a bit lower. And so the last outing for Powell, which was just a day or two ago, he was trying to sort of say, well, restrictive policy is working, nothing to see here. The next move will probably be down. Some people are still thinking that maybe inflation isn't that under control. And the question is, how buoyant is the US economy really? Now, at the moment, Powell is saying everything's fine. We'll just we'll take the data as it comes, and at some point we'll be able to start dropping rates, probably later in the year. Some people are suggesting maybe not this year, but next year. But interestingly, the PPI data on the next slide that came out overnight, that's the producer price, was quite a lot higher than people expected. So a 4.1%. If you take out some of the other factors. Now, some of that was readjustments from earlier on, but PPI is a good input indicator for higher inflation potentially. Overnight tonight, we're going to get then the CPI data from the US. So that'll be interesting. So we could be in a situation where the markets begin to react again to higher rates. But, there's been a lot of volatility, a lot of expectations changed. The Fed, to me, doesn't sound very certain about what's going on, and is trying to pedal back some of the certainty that they had. And we've got some of the other Fed members still saying no rate cuts this year, maybe next year, but we may have to lift rates. So it's a mess.
All right. Next up, so you mentioned US weaker economy. Yeah, some of the things that I was reading about was a lot of the McDonald's in America, and those sort of shops that consumers do spend a lot of dollars are noticing a slowdown from consumer spending.
Yeah, and it is interesting because there is a conflicting story. So the PPI is high, the inflation's high, but the US jobless claims jumped again the other day. The latest Michigan survey on expectations and those sorts of things were up again, and the expectations on inflation were higher again. So it's not a uniform view. And I think you touched on a very important point. Retail in particular is definitely up against it at the moment. Even in the US, retail is underperforming. And in fact, the latest results season in the US around retail was quite a lot weaker than a lot of people expected. On the other hand, the AI story and big tech and all of those things are still supporting. And if you look at the markets, so the markets are now sort of full bore again. Having had a 5% drop, this is the S&P 500, when the expectation of higher inflation and therefore higher interest rates and higher bond rates came through a few weeks ago, that's now almost all reversed. So we're sort of still 8% higher from the start of the year, and probably even going to go higher again. So the markets are disconnected from a lot of what's going on at the moment, and that's partly because they still believe that the Fed will rescue them again. The Fed put is in play. In other words, if the markets wobble, Fed will come in and save them. And the other is that they also think that the US economy is still stronger than most other economies, so therefore it's a good place to put money. So that's one of the reasons why the markets are still full bore. And interestingly, if you look on the next slide, the equal weight analysis, so the slide above is weighted by the footprint of the different stocks in the 500. The equal weight gives this equal weight to all the stocks. And even that is now looking quite high. So the enthusiasm that we saw earlier in the year has still spread even further, despite some of the things we've been talking about, which are slightly concerning in terms of momentum. So to my mind, the markets are somewhat disconnected, and we're seeing peak markets in Europe, high markets in Australia. To my mind, those market valuations are overdone significantly.
Yeah, I guess that's sort of the scenario I've been talking about for a while now, is the melt up and the next recession or even depression that we go into can be that for the average person. At the same time, markets, property, commodities, crypto, everything, they've just printed so much money, and all that money is in the hands of the wealthy. They're still just investing and looking to buy things and whatever, while it's the real depression is the majority of people. But you're not going to see soup lines or headlines like we've seen decades past saying, yeah, we're in a bad recession or we're in a depression or whatever. It's going to be very different because of the new economic policies that haven't been around for that long.
Yeah, no, you're right. A lot of the difficulty is buried. It's like my mortgage stress data. Well, half of households are in difficulty. It means half aren't. And those half who aren't are still spending very freely. They're the ones with all the assets. They're the ones with the shares and the stocks and those sort of things and multiple properties. So we have this sort of duality, interestingly. And what's quite fascinating here is that the story is the same in the US with, the very affluent owning more than half of the economy and everybody else, owning a much smaller share. And therefore, the policymakers who are the affluents, the bankers who are the affluents, are doing things to support their own interests rather than ordinary people. And I think that's the big dichotomy that we face at the moment, because the economy is not working for ordinary people. And in fact, just sort of to develop that, if you go to the next slide, bond yields are now higher again. So interest rates are expected to be higher for longer. This is the 2-year. We actually touched 5% quite recently because of that expectation. Rates, interest rates are still quite a lot higher than they have been for bonds. That puts a lot of upward pressure on government debt, corporate debt, and household debt. And we're seeing mortgage rates in the US significantly higher too. So again, there's a disconnection between the financial markets and what's going on there, and those who are participating in the financial markets, particularly trading on the volatility, and ordinary people who are sort of just, caught in the crossfire. And unfortunately, the crossfire, I think, is going to get more serious. So if you go to the next slide, this was, higher rates have consequences. So we saw the Republic First Bank bailed out on the 26th of April this year, again, because of the high costs of debt and perhaps some misplaced strategies there in terms of hedging. But if you see the list there, there's quite a few. And the other one from the Financial Times there on the right shows there's a huge footprint of debt that is now mispriced on people's books. So if you think of, yields go higher, the price of bonds drop. So we've actually got central banks with big negative values on their books, and we've got a lot of corporates with debt that's actually mispriced relative to the value of the bonds. Now, if you hold them to maturity, it'll work out all right. But if you have to refinance any of this now, that's the risk. And so there are huge risks building because of the dynamics that we've got here and because of these higher rates for longer, and more and more and more of the income from taxpayers is now going to have pay the debt burden that governments are actually created. So again, the cracks are there if you just go find them, go look.
Yes, a little bit reminiscent of the GFC and the collateralized debt obligations, what we've been reading about now with the collateralized loan obligations and the shadow lenders, and trying to repackage these as people chase even higher interest rates. And then we've got the corporate defaults and people just not working in cities, all the things we've spoken about in the past that end up on these banks' balance sheet that now just aren't worth much. So yeah. Crazy system.
And just to add to the craziness, the other thing is private debt. So what I mean by that is a lot of the lending that was previously done by banks to corporates and to other entities and are now being done by private groups and private, very wealthy people, right? Now that private debt is not regulated. That private debt is not reported anywhere in a holistic way. So we actually don't know how much of the debt that's out there in the private sector is actually in existence. But we do know that the big players are heavily invested in the private debt, and they're claiming returns of 10 or 15%. So what they're arguing is, the place to be now is the private debt capital market rather than the public markets, the regulated markets or the banks. So again, what we're seeing is a bit like the global financial crisis, a whole sector of the economy now being fudged and hidden. And my worry is that with these rates that we're seeing at the moment, the chances are we're going to see more defaults later. So it could be commercial real estate, it could be private debt markets, or it could be government debt. Wherever you look, the debt problem is ever bigger. So it's a real problem.
Alrighty, so US government deficits rising very fast.
I think this is a fascinating comparison. Now, the scale isn't quite the same, but you get it, right? So look at the US Treasury. They're issuing massive amounts of bonds at the moment. They issued 100 billion last week. At the same time, the Federal Reserve in the US is doing quantitative tightening, so they're actually not buying bonds; they're actually reducing their bonds holding. So, but if you look at the comparison, right, the amount that the Federal Reserve is effectively giving up is a lot lower than the Treasury issuance. So again, the debt burden in the US, the public debt burden is rising and rising and rising, and of course, with the higher bond rates, as we've said, it's going to cost ever more to service. So this is an unsustainable view, but of course, nobody in the US wants to tackle it. So once again, we're seeing deficits rising. And by the way, in comparison, the deficits in Australia are still relatively low, although they're rising. But in some other countries in Europe and the UK, for example, the deficits are also rising too. So the debt bomb hasn't gone away. It's still growing. It's still ticking. And at some point, it could go boom.
Yes, absolutely. And other countries and currencies struggling just as much.
Yeah, so one of the interesting observations, Bank of Japan, right? So if you look at what the Bank of Japan has been trying to do, they've been trying to protect the yen US because, frankly, the US is king of the dirty shirts, you could say, and the US dollar has been quite strong relative to the yen. And so the yen has been bought by the Bank of Japan as they try to support it. The Bank of Japan has also now lifted their interest rates slightly, so they're moving away from negative interest rates. So there's a real pressure on consequences of different countries. And, it's just worth highlighting that King Dollar is still the best dirty shirt if you look at the US dollar index, but it's having consequences elsewhere. So strong dollar is putting a lot of pressure. It's pressure on the Aussie dollar too as well at the moment. So effectively what you've got the US supported by this massive debt burden and this debt issuance, supporting its currency and then transferring the pressure into other economies, be it Japan, be it Australia, or indeed China. And if you go to China and look at what China's there in the last slide, you can see there that they actually reported the imports jumped 8.4% in April, which exceeded expectations. But the Chinese economy is again under pressure. The markets there are not performing that well. The property market is still under severe pressure, and the exchange rate is still adverse. So my point is that in all of this, you've got the US economy, which is the biggest economy at the moment, grinding forward with ever more debt, whilst the Federal Reserve is trying to put the genie back in the bottle unsuccessfully. Inflation is still stronger than it should be, and there are consequences globally, which then you have to question, how does this play out? Does it play out? Does this go on for a long, long time, or does something break? And if something breaks, what breaks, and what are the consequences? So watch and wait.
Yeah, I guess this is where the Bitcoin crowd, we're getting excited because Bitcoin's grown to the point now where it's in the trillions of dollars as a market cap, and its inflation rate after the halving is now at around 1% or 1.7%. But compared to these 5% all these other countries, we're starting to see banks holding Bitcoin on their balance sheet, and countries, corporations, as well as all these individuals just saying, what, if I'm going to try and save some money, this is the only currency, or maybe gold as well, maybe property's scarce. So this is why we're seeing this flight to anything that's not inflating as quickly as fiat currency. And like you said, I don't think there's going to be the political appetite to solve any of this. So I think it's just kind of like, well, hey, China are going to try and rush to these assets, and Russia and America and everyone. And I don't know how this ends up, but I think it's very bullish for Bitcoin and gold, and probably even property and stocks and anything that's relatively scarce that's a financial asset.
Yeah, gold in particular is interesting because, of course, the gold price has been very high. And interestingly, of course, central banks, particularly from China and Russia and other places, have been buying up gold. But also a lot of people in China are also at a retail level buying up gold because they have less confidence in the Chinese economy. And gold feels like a secure place to be. So that's one of the reasons why the gold price is quite a lot higher than it's been up until quite recently. How this all plays out, who knows? But, for those who want to see them, there are significant cracks wherever you look. And the status quo and the same old can go on for quite a lot longer than people expect. But at some point, the runway gets a bit short. And at that point, all bets are off. Well, there you go. Hope you found that useful. Apologies for not showing no good on screen. I unfortunately had a technology problem this morning. Anyway, we'll look forward to seeing you on the next show. This is Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.